All right, so thanks for joining me in today's options deep dive, where we go a little bit deeper into a detailed discussion. And in today's video, what we're going to do is we're going to take a look at how does an iron condor work and make you money. So we'll break that down in a little bit of detail, and that way you understand. So if you're brand new to trading iron condors, this is a good video for you to give you a little insight on basically how an iron condor works and how you would make money from it. Now, keep in mind, it may be a little more advanced for some people. It may be super easy for other people. But if it's a little too advanced, I highly encourage you to check out our website at tradersfly.com. There's a lot of good information out there, a lot of free things that you could watch and do. So definitely go to the website and continue to learn, download the freebies, and much more. So let's kind of dig deeper into an iron condor and how it works and how it behaves. So to kick things off, the way that an iron condor makes money at a basic level is you're selling some options. Okay, now if you don't know what selling is, it's opposite of buying. So when you're buying an option, let's say you're buying a call, okay, you want the stock to appreciate. However, if I'm selling a call, I actually want that stock to go down. So let's say we're talking about Goldman Sachs. It's kind of like right in the middle. It popped after a little bit. And what we want to do is, if we buy a call, we're going to go to the 23-day, and I will buy this call right here. So I will just click it. It will come up. I will analyze it for you. And now you can see if I buy that call, I want that stock to appreciate, but I lose $9 a day. So that's a bit of a problem, you might say. So in this case, what are we going to do? Well, instead of buying it, we'll actually sell it. So instead of losing $9 a day, we will gain $9 a day. So this is the essence of starting out with selling positions and selling options. So now if the stock actually pulls back, I will profit. I will also profit if the stock stands still, but it is opposite of this buy side. So when you really are selling calls, what's happening is you want that stock to actually go down or at least stay stable. So that's part one, okay? Now, part two of the trade is we'll go to the put side, and it is very similar. So if we do the put side, let's buy a single put. And I will analyze this one. And you might wonder, well, which one? Well, don't stress about which one right now. I'm just going a little further out. If you want to know the delta, it's about between a 10 and 20 delta. So in this case, I'm choosing an 11 delta. If you don't have the delta, pull it up or go kind of where there's some option premium. You see there's $5.60. There's $0 here. So somewhere in between, that'll give me about $1 in that case. And now I can analyze that trade. So this is now buying an option spread again, and that would be bearish from the put side. However, when we sell the put side, we are bullish. So what we have constructed here is now a bullish bet on the stock. And again, we get some theta, because if we were a buyer of it, we would lose that theta or lose about $8 a day. So now we are selling, so we've got that, and we've got now a bullish position. So when selling puts, you want the stock actually to go up. Now, combining these two, what we have here is two positions. We've got one over here on the left at the $120 strike, that's our put, and another one at the our $320 put and the $360 call that we're selling. So now, as long as the stock stays in between this range, we collect both of those thetas. And the most we can make is the combination between these two, which is $1.59 and $1.05. Add that together, you get about $264. So you can see right here, you've got 264 is the most you can make. But you probably wouldn't stay in this the whole time. After a few days of decay, what will happen is the white line, which is today, will get closer to the green line, which is at expiration. And if the stock even pulls back a little bit, maybe you'll get out with just $100 profit. Maybe you'll get out with $176 profit. That stock might wiggle. But what you're doing is you're selling options to collect that premium and theta. Now, what we're doing here, this isn't really an iron condor yet. What happens is this is when you look at all the spread positions that you can do kind of a straddle, which is the same, but you can also go ahead and do a strangle. And what we've really done right here is we've sold a strangle. So in order to turn this into an iron condor, the way that you would do this is I would need to get protection, because the problem with this here is now I have unlimited risk. Well, really till zero for the technical folks on the one side, and then the other side will have unlimited risk on the other side. But really, essentially, in the options business, we say it's unlimited risk, even though it can only go to zero if it goes down. So what we need to do in this case is go ahead and cap it off. So if we sold a call at 360, we can also analyze, let's say, opposite trade. And then what we will do is go to the 365 is we'll buy a single call there. And what that will do is now protect us on this end over here, okay? Because the most now, if it keeps going up, we're protected. And we will do the same thing on that put side. So we'll analyze opposite trade and we'll buy the 315 on the put side. And now this, we have our iron condor. And that's the way an iron condor is built. We essentially have two positions now on both ends, and when we sell those puts and calls, it creates a lot more of a neutral positions. And in this case, we're doing verticals instead of the strangle position, but we have a vertical here on the put side and a vertical over here on the call side. And this creates this almost neutral delta. Now, you could make one stronger than the other depending on how much delta you're packing in there, but that will vary. Now, one problem we have here is we have a bunch of single orders. If you wanted to combine it, there's a couple of ways to do it. This is the Think or Swim platform, but you could right-click one of these, go to Sell, and go down to Iron Condor, and then construct your spread this way. This is one way of doing it. So on the put side, what we had was, let me check because I don't remember, 320 and 315. So we could do 320, 315. And on the call side, we would have 365 and 360. So 360 is the sell and 365 is the buy. So if we construct this spread like this, it will be exactly like the other spread, but it's a lot more efficient to put it in as a single order because now it's a combined order. Because the issue with doing all singles, you do single, 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 single. What if you get 2 out of 4? Or what if you get 3 out of 4 and you're missing one? That becomes a problem. So instead, by putting the order together, that will solve that issue. So this is how you could build out that spread. So instead of doing all singles, now you could have this iron condor doing that trade, putting it in all at once. So if you were doing 10 contracts, let's say, you can put in $4,000 worth. The most you can make is about $1,900, so quite a bit on a percentage basis. And then even if it doesn't go all the way to expiration, let's say you collect maybe just $370. Well, $370 by pulling up a calculator, 370 on $4,020 of risk, you're still at about 9%. So that's the beauty behind these iron condor trades, is that there's a lot of power behind them in the way that you can work with them, trade them, manage them, and vary them up. In fact, if you wanted to, as a little bit more of an advanced thing, you could sell, let's just look at 12 on the put side and 10 on the call side. Or you could bring in the put side 5 more points, making it a little bit stronger of a delta, which makes it a little more bullish. And I could do it another 5 points, go 330 and 325. And there we go. And now we're a little bit more bullish. And I could get rid of a few of the call contracts and go down to 6. And now I'm much more bullish on this iron condor, where if it heads higher, I've got a little more delta though. If it heads higher, I'm a little bit more okay. But if it heads lower now, it's a bit of a trade-off where I could have some issues. So anyways, that's a little bit of a breakdown of this iron condor, of how you might construct it. This one's on Goldman Sachs. We could do another one in another video, but just wanted to share with you how you might go ahead and take a look at something like this, because you know, as you go in and dive deeper into some of these options, it can get a little confusing. Now, I will say, if you want to take a look at our options getting started course, check out tradingwebinars.co. That's kind of like a free website where we have a lot of free webinars out there. So I highly encourage you to check that out, tradingwebinars.co, and it's absolutely free there. There's a ton of free material there, and you can get like some of the jump starting courses there for trading options. So check that out. Anyways, truly appreciate you joining me. Hope you're having a great day ahead, and I will see you in the next video. Thanks.